Hello again, and thanks for watching. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Thursday, the 20th of January, 2022. Markets are moving, reversals big. So let's get right into it and break down what the markets are paying attention to, what the markets care about, so we are too. Thanks for watching. So earlier this week, we had a sell-off, and the sell-off continues as we close today. Unfortunately, the rally that we saw did not hold from earlier levels. The rally earlier was on the heels of the choppy U.S. data. Now, the U.S. data that came out was existing home sales were down. I have a green arrow, even though it's headed down. And the reason why is because inventories are short or low, extremely low everywhere you go. So there's not enough inventory to sell. Therefore, just like if you go for a car lot right now, you can't buy a car. So there's inflationary pressures. There's housing prices that are elevated, but housing is strong because of the demand. But the existing home sales, the number came down. Also, rates are increasing, but that's also a good and a bad thing. I'll get to that in 1 second. And also the data that came out is the initial jobless claims. That was hotter or higher than was originally anticipated by economists. And that's a negative thing, but those combined puts now the Federal Reserve for March about a 50 basis point. Earlier this week, there was a talk about 100 basis points, but it's anyone's guessing game, and ultimately that's what it is. It's a guessing game. And that's why the market actually was relieved, because maybe it's a 25 basis points. And so big tech rallied, or we had a dead cat bounce. So when the market rallies, but it doesn't hold, then we call that a dead cat bounce, and it reverses. Unfortunately, we had the reverse and then a negative close for all three indices today. Now, what's really important on a go-forward basis is we're going to pay attention to how we close on a Friday, because we could see this accelerate, this downturn accelerate into the weekend. And if we do, that means the selling's not over yet. That means it'll continue to Monday, Tuesday, maybe even a Wednesday of next week. Again, this is all sort of what we see in history. When we see strong market sell-offs, we're starting to pick up the VIX, the volatility indexes we're seeing. We're also picking up the volume. The volume has to have a strong volume, high volume, for this to flush out. Keep in mind, if you look at the NASDAQ specifically, from its all-time highs, and they've been in correction territory for at least 3 or 4 weeks now, large cap, big tech, they're already down 10%. Like some of the names that were up even 50, 60, or 100% last year are now down 10% year to date. That's it. That's not a bad thing, because if it was up 50% and it's down 10%, it's okay to take a breather, and solid earnings are still there and the economy is still strong, but taking a breather is okay. And keep in mind, guys, at every single calendar year, when the markets will have two fives and 10% pullback on indices every single year. And so it's not uncommon. Now we're getting that at the front end of this calendar year, and it doesn't feel good. And I understand that. So what we're paying attention to is how we set up for the weekend, and how ultimately we'll see a flush out and a reversal, we believe, probably mid next week. And so we're going to pay attention to how markets close and then how they respond next week. And that's going to be key for us going forward. Now, we have a lot of cash on the sidelines for clients, and we could commit that, and we're just waiting for the market to come to us. And we're also seeing the rotation from big tech to value. And again, we own a lot of the value type plays like financials, which will do better when interest rates are rising. That's not a bad thing. Like I said before, when interest rates are rising, that means you have a healthy, strong economy. But you don't want the Federal Reserve, and that's what the manic depressive is about the market, or the tantrum that we're seeing, that you don't want it to happen too quickly. And that's what every day we're waking up on, and we're wondering, and we're waiting, and we're anticipating, and we're forecasting. You know what? At the end of the day, let's go to quality earnings, well-run companies, long-term view. We're going to be okay. And that's what we own here. Also, we want to watch the rates. That's why the market has been ultimately in correction territory. All the three indices, the NASDAQ technically is in the 10% plus because it closed there yesterday. And the reason why I got there is because interest rates were rising, obviously, but the rate of change was so quickly. So when things changed, so we went from a 10-year treasury at about a 1.3 to now a 182, but really rapidly in less than a few weeks. Markets really have to rebalance and reprice, and that's what we're seeing play out as an example. So the market sell-off continues. It's not a fun period of time for sure, but we've got quality companies, well balanced, and we also have cash on the sidelines, and we can rebalance strategically like we normally do to take advantage of any opportunity that's coming our way. And valuations on some of these tech names that we don't have in portfolios are getting very, very attractive right now. So we could be going shopping sooner than later. We just want to be patient, and we want to ride this out and see where we go. So thanks for watching today. And if you have any questions, comments, want us to review, we're here for you. Thanks for watching. Take care. We'll see you again.